What's up, guys? Ruben Tech is back here today, and we're going to be talking about leverage ETFs. Now, the first thing I want to tell you is this is extremely risky, and if you're going to be doing the risky, then you better do the frisky. I've heard another YouTube say it, and I really like that. That just means that I'm not your financial advisor. I'm not your mom. I'm not obligated to you in any way. These are highly risky, so make sure that if you are even thinking about doing this, that you do your due diligence. Now let's go ahead and get into them. First thing I'm going to do is I'm going to tell you what they are. You can skip over that if you wish, if you already know what they are. And the second thing I'm going to do is I'm going to show you an example of an extremely risky, highly leveraged product derivative, which is called MSTX. Is based off of MSTR, is 2x the daily performance is what they try to achieve. And as you know, MSTR is already extremely volatile, so this stock is just a literal roller coaster. Okay, let's go ahead and get started. Here is the book explanation. A leverage ETF is an exchange traded fund that uses borrowed money and derivatives to amplify the returns of an underlying asset, such as an index, sector, or commodity. They aim to multiply the daily returns of their benchmark, typically by 2 to 3x. How they work is they have leverage. They borrow money to invest in the underlying asset, magnifying gains and losses. They are a derivative, but they use derivatives such as futures and options to achieve the leverage exposure that they are seeking. They have a daily reset, which means the leverage is reset daily, meaning the ETF aims to achieve the specified leverage each day, not over the long term. I.e., they're looking to hit NVIDIA. If you have NVDL as 2x, NVIDIA is looking to hit NVIDIA 2x for that day, not NVIDIA 2x for the entire month. And you will see that there's a big difference between those two things. Now, the benefits of this is that they have magnifying returns, of course, because you have a potential for higher returns than traditional ETFs if the underlying asset moves in the anticipated direction that you were hoping for. So remember, you can go long with these. You can also go short. Short-term trading can be useful for short-term trading strategies to capitalize on market movements. So if you really feel the market's going to move one way, maybe you're going to get TQQQ, which is an investment in the market, and you put in double exit. And then increased exposure allow investors to gain greater exposures to an asset class with less capital up front. So very much like options in that sense, except that you don't lose everything. You can lose everything, but you don't have that fee essentially that is just lost at the beginning. So the potential risk, magnified losses. Losses are also amplified if the underlying asset moves against the investor's position. The volatility, leverage ETFs are more volatile than traditional ETFs, increasing the risk of significant losses, especially MSTX. You'll love this one. Compounding risk. The daily reset of leverage can lead to unexpected returns over the long term, especially in volatile markets. And leverage fees. Leverage ETFs typically have higher expense ratio than traditional ETFs. And the reason for that is that they are managed daily. Remember that daily reset? Every single day, the managers are coming in. They're setting up these derivatives to achieve 2 to 3x their performance, whatever their target is, of the underlying stock or asset. Okay, so they have to do that daily. So where you might have a large Vanguard mutual fund that is managed and it has like 0.0035%, less than 100th of 1%, so less than 1,000th of 1% or whatever for a fee, right? These typically have fees that are close to like 1 or 2%, but they're going in and they are actively managing them day by day. So that is understandable. And so then the other thing is that each day they're looking for 2x or 3x. They state their target, but they're but they usually don't hit it exactly. So it might be like 1.99x, or next day it might be 2.01x. And because of this, we have something that's called volatility decay, because they are reset daily, right? Maybe you go on a stretch of 1.9, 1.95x for gains for 3 days, but then in the next 3 days you have losses, and it's 2.1, 2.05, 1.95. So you have this volatility that can happen. It can be, it's not exactly 222 for those 6 days. There's some risk, and you could be on the downside, could be on your up, right? So it could be slightly under, and then when you're under, going down, it could be magnified, right, with a 2.05 or something like that. So that's a little bit of decay. Also, they have the natural decay due to just being amplified, i.e. if you have $100 in MSTX and Master moves up 10%, then MSTX is going to move up 20%. So now it's going to move up to $120. Whereas Master, if you had $100 of that, it would move to $110. Now, the next day, if Master goes down 10%, right? So it went up 10%, then goes down 10%. Well, now 10% of $110 is $11, is at $99 for a net loss of $1. But you are going to go down 20%, and you're going to lose $24. You're going to be at $96. You're going to be $4 under. Okay, so you see that increased volatility decay right there. Okay, it's not a good thing. Take a look at MSTX. This is one that I've had, and it looks like, oh man, it's already moving down. Look at that, it's lost 42 cents. It came out just a few months ago, and as you can see, it's literally at one point it had almost 8x or 7x. This is 7x in just 3 months. So talk about volatility. You could have put in $100 and you would have been at $700 right here. If you put in $100, you'd still be at like over $500 here when it opened up. I got in after Trump was elected. I figured that Bitcoin, well, the stuff he said, it would go wild. MSTR is seen as a play on Bitcoin. So I thought, hey, I'll throw some money in this. It's essentially seen in my mind as being a 2x play on Bitcoin. I know it's not tied directly to it, but it's kind of the same thing. And you can see, yeah, after November 7th, it did skyrocket. So I did very well. But I did buy on the way up. And I probably shouldn't have did that. I should have probably just let it ride up and then try to find a peak and start selling on the way down here. But I didn't, because I just thought that Bitcoin was going to break through that 100x, right? And so you can see, very volatile. Look at this, one day, boom, right? Huge drop just in one day from here, 170 all the way down to 118. So that's a big percentage lost right there. But that's what these are. And so that's the example of this. And as you can see, this is from Title Trust. Title Trust 2 defines daily target 2x long MSTR ETF. So how do you read this? Well, it's from Title Trust, right? It's their daily target is 2x the performance long, because you could be short. You could be short MSTR, but this is long MSTR. And this is the ETF. Okay. And this is an example, I would say, of probably one of the more risky. I mean, this is basically you're sitting down at the craps table, which is why I'm telling you, I'm not a financial advisor. I do not recommend doing this. If you're going to do this, make sure you are comfortable with the idea of losing all your money, because it could very well happen. But, so I do know that there is a 3x MSTR. I believe it's from Granite Shares, but they don't have that available on Robinhood, which is probably a good thing, because this is already risky enough for me. So anyways, I hope you learned something today. This is, we talked about the definition, the formal definition of leverage ETF, and then I gave you examples of that's more volatile. You, of course, could do something such as TQQQ, which isn't actually that bad. These pro shares, they look to, they're tracking 3x leverage exposure to a modified market cap weighted index tracking 100 of the largest non-financial firms listed on the NASDAQ. Okay, and so you might say 3x, that's worse than the one that you have. Well, no, because the 100 stocks in the NASDAQ, they don't move as much as MSTR. MSTR can move 20% in a day, no problem. These aren't. And you can see just for the year here, yes, it's went up, right? It's went up 80%, which is very good considering this is based off an index, right? However, MSTR, as we saw since inception, has went up, or sorry, MSTX since inception has went up already 500%, Actually, I think it's close to 600% in just like 3 or 4 months. Okay. Now, of course, because it's amplified like that, Bitcoin shot down to 60%. Let's say that Bitcoin crashed a little bit here. That MSTX, it could get wiped out, which is what I'm saying. If you're going to do this, be 100% comfortable with losing everything you have. Okay. That's all I got for you today. I hope you really enjoy this. Be sure to hit the like and subscribe down below. I'm trying to help you guys out. Give me some feedback back, but you got to help me out. Hit like and subscribe. Thank you very much. Have a great day.